Okay, let's be honest for a sec. Have you ever felt like managing your money these days is less about making smart and more about just trying to keep your head above water with all the advice flying around?
Oh, absolutely. The information overload is just, well, it's huge. Yeah, finding what's actually useful, that's the tricky part.
Exactly. And that's really why we're diving in today. We've got this great set of sources pulled together by Consumers.App for June 15th, 2025. Our mission really is to kind of unpack the important stuff for you, cut through that noise, and maybe find some surprising insights from the material you brought us.
Yeah, we're covering a lot today. Everything from, specific strategies like emergency funds to big economic things, how banks operate, scams, even budgeting tips. It's a real snapshot.
Okay, let's kick off with this headline from the Texarkana Gazette. 10 sources of emergency cash ranked from best to worst. Now, inside this, the Consumers Research Q&A got into something interesting, using life insurance for emergencies, specifically the infinite banking concept.
Yes, IBC. It's a, let's say, niche personal finance strategy. It uses certain kinds of whole life insurance policies, the ones that pay dividends. The basic idea, often linked to R. Nelson Nash, is you build up cash value in the policy.
Yeah.
Then, and this is the core part, you borrow against that cash value.
So you're acting like your own bank. Is that the idea?
That's pretty much it. The goal is to sort of recapture interest you'd otherwise pay out and gain more control by financing things yourself. Emergencies, cars, whatever.
Okay.
Yeah.
Sounds different. But how does that cash value actually turn into cash when you have an emergency?
Right. The source material lays out two main ways. First, you can just withdraw cash directly from the value. But, and this is critical, any withdrawal permanently reduces the policy's face value.
Sure.
Your death benefit shrinks. The second way is borrowing against the cash value. So you get funds, no traditional loan application needed, but it is still a loan, usually with interest, from the insurance company.
And it needs to be repaid.
Exactly. If you don't repay it before you pass away, the outstanding loan plus any accrued interest gets deducted from the death benefit.
Okay, now the Consumers Research highlights some expert criticisms. What are the big downsides people point out? This sounds potentially complicated.
It definitely can be. Experts often say IBC is, complex and can be much more expensive than other options. Besides hitting the death benefit, those whole life policies have really high premiums compared to term life. Plus, the interest rates on the policy loans themselves might not be that low, and there could be fees. So that idea of recapturing interest, it might not fully pan out.
Yeah, it sounds like you need a lot of money flowing in just to afford the premiums before you even think about borrowing.
Precisely. And the source notes that because of all this complexity and cost, it's generally outside mainstream advice. Most advisors prefer simpler, more transparent tools for emergencies.
So if it's potentially tricky and costly for the policyholder, why are insurance companies promoting it?
Well, the research suggests it's good business for them. They sell expensive whole life policies, much more profitable than term life. They earn interest on those policy loans too. And, the complexity itself can sometimes keep people locked into the policy long term.
Okay, so if IBC isn't the simple go-to for emergency cash, what alternatives does the source mention, the more standard stuff?
Yeah, the usual suspects. Building a dedicated emergency fund, like in a high-yield savings account, getting a line of credit before you need it, using credit cards but responsibly for really short-term gaps.
Yeah.
Or maybe a personal loan. Generally simpler, clearer costs.
Right. So the big takeaway here isn't necessarily that IBC is bad, but maybe for that specific need, quick, low-cost emergency cash. Simpler options like savings or a line of credit are often, more practical. It's about understanding the costs.
Absolutely. Know what you're getting into. Okay, moving on. A headline from WPRI 12 News. Mortgage rates simmer, but borrowers might get a cooler autumn. This points right at those big economic forces affecting interest rates.
And the Consumers Research for this one drills down on one key number, the CPI, the Consumer Price Index.
Yeah, it's pretty interesting how one monthly statistic can sway something as big as your mortgage payment.
Okay, totally. So break it down for us. What exactly is the CPI?
Okay, so the CPI is basically a statistical measure. It's the Bureau of Labor Statistics, the BLS here in the U.S., puts it out monthly. It tracks the average change over time in prices paid by urban consumers for a specific basket of goods and services. Think food, housing, gas, clothes, the stuff people buy regularly. It's weighted, so housing costs more, it gets a bigger weight. It's our main way of tracking inflation, basically, cost of living changes.
And the source mentions a milder than expected CPI report. What does that signal for mortgage rates?
Right. If CPI comes in lower than forecast, it suggests inflation isn't heating up as much as people feared. That usually means the Federal Reserve feels less pressure to hike interest rates aggressively. And lower expectations for Fed hikes often lead to more stable or even slightly lower long-term rates like mortgages. So a cooler CPI can mean, cooler borrowing conditions.
Seems like it tells us a lot about the whole economy, not just rates.
It really does. The source points out it's a huge indicator for policymakers and businesses. Why? Because it shapes consumer behavior. If CPI is shooting up, prices rising fast, people tend to pull back on spending, right? That slows economic growth. If CPI is stable or falling, confidence might go up, people spend more, growth picks up. It's key.
What are the main things in that basket they track?
The big ones listed are food, shelter, that's housing, apparel, transportation, medical care, education, recreation, basically where average folks spend their money. The BLS updates it periodically, too, to keep it relevant.
And the BLS handles all the data crunching, CPIU, CPIW.
Yep, they collect millions of price points every single month. They calculate the weighted averages, publish the detailed reports. It's foundational stuff for economic analysis, Fed decisions, even cost of living adjustments for things like Social Security.
So bringing it back to the listener, how does knowing about the CPI help you make financial decisions?
Well, keeping an eye on it gives you a sense of the inflation picture. Is the cost of living going up fast? Stable? That can help with budgeting, obviously, but also maybe timing big decisions. Like if inflation looks like it's rising, maybe you want to lock in a fixed mortgage rate sooner rather than later. It just gives you context for your planning.
Okay, clear takeaway then. CPI isn't just some abstract number. It reflects real price changes and can directly influence things like your mortgage rate and overall purchasing power. Worth paying attention to.
Definitely. Okay, next up from the Sydney Morning Herald. How banks are muddying the waters for savers as interest rates fall. This gets into how banks actually decide on the rates they offer.
Yeah, this feels a bit murky sometimes, doesn't it? And the Consumers Research Q&A digs into those dynamics. It's not just about the Fed's rate, apparently.
Right, it's more complicated. The relationship between, say, the Fed's policy and your savings account rate isn't always one-to-one.
How does that connection work then, generally?
Well, the source explains that central bank moves like the Fed, raising or lowering its key rate, directly impact how much it costs banks to borrow money themselves. So if the central bank hikes rates, banks' costs go up. They'll likely raise their lending rates to consumers to protect their profit margins. If the central bank cuts rates, banks' costs go down, and they might lower rates to attract borrowers. That's the basic link.
Okay, standard enough. But the research mentioned something about competition in Europe that sounded odd.
Yeah, that was interesting. A study mentioned found that more local banking competition was linked to slightly higher household loan rates, not lower like you'd maybe expect.
Wait, higher? More competition made loans more expensive. How does that work?
I know, it feels backwards, right? The study suggested other factors were at play: the main European central bank rate, country risk, currency value. It could be that intense local competition forced banks to maybe pay more for deposits, or they priced loans a bit higher to cover costs in a crowded market compared to bigger players. It just shows market dynamics aren't always simple. The research also touched on something from before the 2023 U.S. banking issues, how banks handled the risk of deposit runs as rates rose in 2022-23. The finding was that banks generally didn't fully hedge against that specific risk using all the tools available. Some tools showed a connection, but others, like certain options, didn't seem to be effectively used for that particular threat.
What does that mean in plain English? They weren't fully prepared.
Kind of. It suggests that even sophisticated banks might not always perfectly anticipate or manage every risk, especially fast-moving ones like depositors pulling money due to rapid rate changes. It's a reminder that the system has complexities.
And how does this compare internationally? Like the UK, the source mentions SONIA.
Right. SONIA is the UK's key benchmark rate for overnight lending, sort of their baseline risk-free rate. Changes in SONIA reflect UK monetary policy and market conditions. If SONIA goes up, borrowing costs generally rise across the UK system, affecting bank rates. If it falls, costs ease. It's their equivalent foundational rate.
So banks are juggling all this: central bank rates, competition, risk management.
Exactly. The source adds they use financial tools, derivatives like interest rate swaps, futures, options basically to hedge their bets. Like a swap might let them trade a variable rate they pay for a fixed one to protect against rising interest costs. It helps them stabilize things in volatile markets.
And the prime lending rate fits in here too.
Yep, prime rate is usually what banks charge their best corporate customers. It acts as a benchmark for many consumer loans like variable rate mortgages or HCLOs. Your rate is often prime plus or minus a certain margin based on your credit and the product.
Okay, so the takeaway is The rate you get isn't arbitrary. It's this complex mix of huge global factors, local competition, how banks are managing their own books, and these complicated hedging tools. Way more going on than meets the eye.
Definitely. All right, shifting gears significantly, a really important headline from the Boston Globe, a roadmap to help elders steer clear of financial scams. This is critical stuff.
Absolutely crucial. Scammers are just relentless, and the Consumers' research here outlines their main playbook, especially for targeting seniors.
The big thing that jumps out is social engineering. That's their main weapon.
Explain that social engineering. What does it look like?
It's basically manipulation, tricking people. Scammers pretend to be someone trustworthy, the IRS, Microsoft tech support, even a grandchild in trouble. They build fake trust or create panic to get personal info or money. They prey on politeness, maybe unfamiliarity with tech, or just a desire to help. Mitigation is about awareness, skepticism towards unsolicited contact, and basic digital security. But the source really hammers home the importance of family support here.
Yeah, that seemed key. It's not just about antivirus software. Family can educate seniors about common scams, offer emotional backup, and critically, be a verification point. Like if mom gets a weird call demanding gift cards, having a son or daughter she can call first to check. That's huge. The source even cited a study from China showing how younger relatives actively protect elders this way.
And the money involved is just staggering. It really is. The research mentions over $3 billion lost annually to elder fraud just in the U.S. And trends aren't great. Digital scams are way up, especially since COVID pushed more activity online. Technology just makes it easier for scammers to operate globally and adapt fast.
Is anything being done legally to fight back?
The source notes some U.S. efforts, like the Elder Abuse Prevention and Prosecution Act from 2017, trying to up penalties and improve data sharing. The American Rescue Plan had some funding, too. These help strengthen the framework, but honestly, they're often playing catch-up because the scams just keep morphing.
What are some common scams people should be aware of right now?
The research highlights a few usual suspects. Tech support scams. Your computer has a virus. Pay us to fix it. Phishing emails trying to steal logins or bank details. Even fake online pharmacies selling counterfeit drugs. The core advice is always, be super wary of anyone contacting you out of the blue asking for info or money. Hang up. Delete the email. Independently verify by calling a number you know is legitimate. Talk to family or advisors first. Awareness is step one. And those social engineering tactics, they evolve. They use current events. COVID scams are huge. The gift card scam is another big one, impersonating companies, demanding payment in gift cards. You've got to stay informed about their latest tricks.
What about new things like cryptocurrency? Are seniors being targeted there too?
Oh, absolutely. Crypto's novelty and, let's face it, complexity for many people make it a prime target. Scammers set up fake exchanges, push bogus investment schemes, promising crazy returns. Seniors can be vulnerable if they're not familiar with how crypto works or how to spot red flags. So education about secure investing and specific crypto scam warnings is becoming really important.
Okay, so the big message here is scammers are creative and persistent. Protection means being vigilant, recognizing red flags like unsolicited contact, demanding urgent action or info, staying updated on scam types, and maybe most importantly, having that trusted network for support and verification.
Couldn't agree more. Okay, last headline, a practical one from AOL. 5 expenses to cut from your budget when housing is expensive. This hits close to home for a lot of people right now.
It really does. Housing costs are squeezing budgets everywhere. The Consumers Research Q&A offers some solid advice for managing that pressure.
Yeah, it really comes back to fundamentals, doesn't it? Core budgeting.
Exactly. The main strategies are about, creating a detailed budget, really knowing your essential versus non-essential spending. Using savings smartly, having that emergency fund we talked about earlier is vital. Using credit carefully, not living on it, and keeping an eye on your credit score. That came up too.
Now, interestingly, the source material here also touch on some tech stuff. AI in finance, retail innovations. Seemed a little broader than just cutting costs due to housing, but it was in the mix.
It was. A quick mention of AI personalizing financial products, helping detect fraud, assessing risk. The idea, I guess, is that AI could help build trust by tailoring services better.
And the retail tech.
Yeah, things like mobile payments, AI giving personalized discounts, maybe even future stuff like VR shopping. The connection seemed to be that these might help consumers find better deals or make more informed choices within their budget, especially when prices are high, convenience, and maybe tailored savings.
Okay, but back to the core challenge. High housing costs impacting other essentials like groceries or utilities. What do experts recommend there?
Pretty practical stuff. For groceries, serious meal planning to cut waste and control spending at the store. For utilities, energy-efficient appliances, being mindful of usage. For transport, looking at public transit, carpooling if possible.
It's all about optimizing where you can, finding ways to trim those other necessary costs to free up cash.
And why is monitoring your credit score extra important when housing is taking such a big bite?
Because that score heavily influences your ability to get loans and, crucially, the interest rate you pay, especially mortgages or refinancing. A good score means better terms, lower payments. When housing is already expensive, getting the best possible borrowing terms can make a real difference to your overall financial stress. So, checking reports, fixing errors, it matters.
Right. So the clear takeaway here, when housing costs are high, mastering the basics of personal finance is non-negotiable. Budgeting discipline, actively managing all your expenses, protecting your credit health, those are the keys. Fancy tech might help, but the real work is in those everyday habits.
So we've really covered a lot today, haven't we? From digging into the details of something like infinite banking, to understanding how big things like the CPI and bank strategies affect your rates, to staying safe from those evolving scams, and then landing on those fundamental budgeting tactics for dealing with high costs. It's a wide view of consumer finance right now.
It really highlights how connected everything is: personal choices, global economics, tech changes. It all fits together.
And huge thanks to you, our listeners, for bringing us these sources. This Consumers.App aggregation gave us a lot to talk about.
Definitely. So here's a thought to leave you with. We talked about how scams exploit trust, right? And how banks manage their own risks. Where in your own financial life do you think trust, who you trust, how much you double check, actually plays the biggest part?
Something that you want.
Remember to like, share, and subscribe Consumers 360.